Welcome to Barchart's series of educational webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer some traders insight to help you make a more informed trading decision. Today's session, precision trading with Bollinger Bands, identifying breakouts and reversals. Now, wouldn't it be nice if we had a tool that tell us when the price of a market had moved too far or too fast, or gives us a warning that it's time to ring the register, or better yet, a permission to take a position that is aligned with our primary trend? Well, in the 1980s, John Bollinger developed a technical analysis tool that measures volatility using a simple moving average and two trading bands around that moving average of two standard deviations. Bollinger Bands. Now, traders today rely on the outer bands as price targets for entries and exits. And since Bollinger Bands are based on volatility analysis, another application takes into consideration the width of the bands. In low volatility conditions, bands contract, and in high volatility, they expand. Now, these two conditions can be the precursor to changes in volatility and, more importantly, price movement. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And if you're not using Bollinger Bands to help you precisely time entries and exits, then you're missing out on one of the most essential technical analysis tools. So stick around as I offer 3 applications that will enhance your trading confidence. Now, before we get to all that, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Hi there, John. How are you doing?
I'm doing
Happy
well.
spring. Yeah, happy spring.
Oh,
Springtime
yes.
already.
Spring has sprung. Definitely
Right.
today. I think we're going to be 70 degrees and all my little flowers are starting to pop. I don't know, how's it in Chi-Town?
Kind of gray today, but getting there. It's
Getting
getting there.
there.
Yeah.
Maybe the groundhog was right. He needed another week or two, right?
Yeah, I think so. We'll get there. We
All
better.
right, Gene. You ready to jump into it?
Absolutely. Let's get going.
Okay, great. Just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities or commodities or any other investment involves risk and best made on the advice of a qualified financial professional, and under no circumstances shall we be liable for any losses that you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages based on the information or material you receive through barchart.com and our services. Okay, so Bollinger Band definition, right? Bollinger Bands are a technical indicator that measures price volatility using two standard deviations above and below a 20-period moving average. Now, just be understand that whatever time frame we're using on our chart, and we're using Bollinger Bands, typically folks will use Bollinger Bands in the daily time frame. But if you're looking at, let's say, a 60-minute time frame, and you're using a Bollinger Band, then you're looking at a 20 period or a 20-60 minute moving average. So it's 20 periods. Now, Bollinger Bands are a measurement of volatility and are not a predictor of price. Rather, depending on how we're going to use them, they can make us aware of potential changes in volatility and the probability of price movement. Now, Bollinger Bands are created, 2 bands around a simple moving average, and traders generally use them to determine overbought and oversold conditions. Now, when price reaches the outer band, the condition the price has reached an extreme. Now, in theory, tells us that 95% of the time, price will remain within 2 standard deviations. So outside or on is a low probability occurrence, but a high probability event. Now, Bollinger Bands identify the divergence between prices and a moving average. And the wider the bands, the greater the volatility. The narrower the bands, the lesser the volatility. Now, these two conditions will play an important part in our application of our analysis. When these conditions can be confirmed with other technical analysis, for instance, price structure or momentum indicators like RSI or MACDs, will only increase our confidence in our price outcome. And Bollinger Bands can be applied in all time frames. However, they carry more significance when applied to weekly and daily charts. So finally, what we're going to do is we're going to learn how we can blend or overlay Bollinger Bands analysis between multiple time frames. And this is to achieve a critical risk assessment and trend recognition for our entries and our excess. But like all technical analysis, they have greater significance or confidence in higher time frames. Okay, so let's talk about our first application. So when the bands are narrow or they come closer together, price it has consolidated or is gathering energy. Sometimes it's referred to as coiling. And then when price breaks out of the narrow bands, this is an indication that volatility is returning and price movement of a greater significance is about to ensue. So let's go to back to our chart, and this is Microsoft that I showed on the opening slide. And let me do this. Let me break this out to a larger chart so we can kind of play with this. All right, so let's go back in a little bit in time. And I think, here we go. All right. So here is a good example of low volatility, narrow bands, and then that potential when price breaks out. So this large green candle right here accomplishes two things. First, it's reaching the outer band and it is breaking away from a previous coiling or range, and that breaking out of this resistance. This is a bullish signal. Now notice how the bands turn out. This is an indication of a period of a high momentum and the beginning of a price movement. In other words, a trend. Here we can see it again. We have our bands are narrowing, and then this green candle and followed by this green candle break out of the previous resistance. And you can see that our mean here continues to move in an upward manner as price carries along the upper band. This is a mean confirmation of our trend. And from a trading aspect, this is when we would incorporate our trend following type strategies. And I have one more again here. Again, notice how our bands narrow quickly, then price breaks out of a previous range, carries along the outer band, and is confirmed by a rising mean or moving average. Here we are looking at Apple. Again, you can see our bands have narrowed. We break out of a previous range of price. Price carries along the outer band, and the price action is confirmed by an up-sloping mean. Now, let's go back to our slides for a second. So our second application that we're going to look at is when our bands are wide, and this is a sign of high volatility and that the price is accelerated too quickly. Now, the expectation is that the volatility and the price will revert to the mean and mean reversion strategies. So mean is just another word for a moving average. But think of this in this terms. Price has stretched the bands. Maybe it's traveled outside of, or it has been piercing the outer band. But ideally, we want to find a whole candle or a whole bar outside of the band. And then the expectation is when pressure has been released, the pressure that drove price and volatility decreases, let's say buyers or sellers dry up, then the price will return inside the band and price will snap back to the mean, back to normalcy, normal volatility. And these conditions are ideal for what is called mean reversion strategies. So again, let's go back to our Microsoft here. And I want to go back a little bit in time. And here's a great example of that. Notice that we have a whole candle outside of our Bollinger Bands. And that when price returns inside of it, it has a much higher probability that it's going to return back to the mean, a mean reversion strategy. Now notice the width of the bands here, right? You can see how wide the bands are. This is one of the conditions we want to look for mean reversions. Notice how narrow our bands are here on that breakout, right? So there is a difference between the width of the bands will help enhance our mean reversions and our breakouts. Now again, you can see it here where we have a whole candle outside. Now the bands aren't as wide as they were here, but we did see when price returns inside, there's a higher propensity for it to return to the mean. Now, typically, but it's not uncommon that we will traverse from band to band, especially when we're in a extremely oversold or overbought extended condition, or in this case, which is common, is when the market is establishing a new consolidation range as it is bouncing between coiling bands that are getting narrower and narrower. And then eventually, then we do see that potential breakout. So here's Tesla, okay? And I have two circles here. Now, why did I do these two circles? Well, we said that Bollinger Bands work better when they're in concert with other technical analysis. So I do have some templates, and I think we have a bar chart template that I can help us with. Yeah, here we go. So notice where this is a RSI, relative strength index, and then here is a MACD, a moving average convergence divergence. Notice that this circle here, where this candlestick formation is in what is called an overbought condition. And here we can see this is an extreme high value for a MACD. Again, on the opposite side here, we can see that this condition is a oversold in the RSI and a deep MACD in terms of negative momentum. But if we go to, let's say, Bollinger Bands, now let me just take a moment here and show you that you can find the Bollinger Band under the indicators And there it is. It's an overlay study that's going to put on top of your charts. And inside of the Bollinger Bands, you can click there, and there would be your defaults for it. A 20 period, two standard deviations, whatever the source you want to use, either the close, high, low, close. There's a couple of different ways. And then I've reconfigured mine, changing the colors a little bit as well. So again, notice how now the whole candle is outside of the Bollinger Bands that is in concert with overbought and oversold conditions. And so these would have been two great setups. Now, also what we notice here is, and this is one of the advantages of a Bollinger Band, this also is kind of alerting of us of the end of one cycle of a trend and the end of another cycle of a trend. Now, not all systems are foolproof, and some of you who are looking at this would say, well, how come we didn't get a mean reversion here? Or how come the trend didn't reverse here? Or here when price fell outside of the Bollinger Bands? So this is where risk management is really important. In this case, we're taking a buy order, or we're trying to buy in a downtrend, right? A contrarian trade. And so this can be difficult with mean inversions, and this is why we need to have proper risk management. So a risk management of an entry, let's say as price returns inside the band, would say, hey, let's not let this price fall back below. In other words, making a new lower low in our downtrend, making a new lower low in our downtrend. But let's reverse this process and think about this as targeting as a perspective for risk management, where price has moved in our favor. Let's say we were in a short position. This would have told us that price had moved too far too fast, and this reversion setup can also be an exit strategy for trend following systems. Now, we could be waiting for a re-entry when price returns closer to the mean or on the mean, or when it breaks out on higher momentum. Now think about what we're doing here. We're setting up exits when volatility gets high, and we're looking for re-entries when it returns to normalcy or back towards our narrowing bands and or our mean. And this will allow us to re-engage the current trend. Now, we'll come back and look at this trade. Why did this candle collection create a mean reversion? And later we'll go to Microsoft, and I'm going to show you how to engage with a current trend. So that brings us to our third application, which is the art of multiple time frame analysis. So first, we're going to establish a course of action or a setup condition in a higher time frame, and then using a lower time frame to better time our entry or exit. And this is also going to help us with our risk management. So let's go back to that Tesla chart. And again, let's blow this out so we can see it. All right, so why didn't the market really mean revert when we had price go outside of the band? Here we had almost a whole candle outside of the band. And why did it work here? Well, this is where multiple time frame comes in. So now notice that we're in a daily time frame. So let's go up one time frame. Let's go to a weekly chart. And notice these blue lines. Remember these blue lines? That was where we were at the low of outside of those bars that went outside of our Bollinger Bands. And I'll go back to daily. You can see that. But notice this blue line here, right? So we're in the weekly, And what we're doing here is we're setting up the conditions. In other words, a range of probability, right? We know that 95% of the time market is going to stay inside of 2 standard deviations. So outside of that, that is a low probability occurrence and high probability event. And so you can see here, if I go up here, right here, you can see this little green number here, that value on the weekly at this 10 was around 240, 240.17. And, you know, that's kind of where I drew this line. It's off a little bit here, but we can move it up just a bit in that range. So this would be a higher probability event in terms of waiting for price to get outside of that to look for that condition and now give us the permission to do the setup. And again, if I go back to my daily chart, notice that there is that blue line around that 241 level where we are outside of both the weekly and the daily Bollinger Band. So now what we just need to do is wait for price to return inside of our daily and weekly Bollinger Bands, and that would give us a buy signal. All right, so let's switch from Tesla to back to Apple. And again, you know, very similar here, right? Notice how our bands turn out. We're getting increased volatility. We have 2 candles outside of our Bollinger Bands as our bands are starting to turn out. But notice this 3rd candle here. This is the one that actually started the reversion back to the mean. Again, if I step back to a weekly time frame, right? Notice that we have kind of parallel Bollinger Bands, maybe a little turning out here, but there you can see that red candle where we are finding the right conditions based on the Bollinger Band that we can start looking for setups. Here you can see that if I look up here, that value I made into a gold line is 1438 to 1438. So that is where we're outside of the weekly bands for that condition. Go to the daily, right? Looking for the setup. Again, now we have these 2 candles that are outside our Bollinger Bands. And so where would price have to go to get back inside of our daily Bollinger Band? Well, again, you can see up there, it says 212.83. So there is the condition at the weekly. Now we're getting the setup in the daily. But here's where we're going to go down to a lower time frame to give us that setup and the execution to our trade. So again, let's go back in time a little bit here. And let me make this nice and big for you guys. So again, remember the gold line is the weekly Bollinger Band. The green line is the daily Bollinger Band, the outer band on the downside. Now notice here we're in a 30-minute time frame that we do get a piercing. So let me just pause here again. So when you do this analysis, when you go from a daily down to an intraday, so I know some of you are going to ask me like, well, what time frame should I use? Now, again, it really kind of depends on the market you're trading, or depending also on how much risk you're willing to take. Obviously, the larger the intraday time frame, the greater the risk. The lower the time frame, the lower the risk. But you know, you could do an hourly, 2 hours. You could do 15 minutes. I would, though, I'm going to say, be a little bit reluctant to using anything less than 15 minutes, like a 5-minute time frame, because you're going to get a lot of false signals in terms of this execution. So I would wait for a little bit a higher time frame. So here we are 30 minutes. So what we're waiting for is price to regain, get inside of our daily moving average. Notice that in this Bollinger Band piercing, our mean reversion at the 30-minute is the outer band of our daily. That would have given us that buy signal either on this candle or on these candles. Now I'm still going to need to risk the low of this candle when I set that trade up. Now also, if I move forward in time, again, some of the things that we can think about is I know that I'm in a mean reversion. I know that I'm probably in the beginning of a short-term uptrend. And these are the conditions we kind of really want to look for, where we're in the outer band on the downside to an uptrend. Here, what we're doing is we're engaging an uptrend in an oversold condition. And that would be a great setup. These are much rarer to find, but they are really high probability trades. But eventually we do get our narrowing of our bands and that impulse rally. So let's go back to our daily so you can kind of see this. This will be a little clearer again now that we've kind of walked through this, right? So now we have two candles outside. We know that we want to be inside of the Bollinger Bands to take that trade. So I can come over here and open this panel up. Now, if you don't see your tools here, there is a little arrow here that will open that toolbox up. And I'm going to do the risk reward. So here we can go in and we're going to take a buy when price returns inside of our Bollinger Bands. And we're going to set our stop at the low of the candle that went outside of our Bollinger Bands. And at the time of the trade, we're going to set up a mean reversion. In other words, we're going to go back to the mean. Now, notice I set this trade up that the risk reward ratio is about 5 to 1. And this is important when we're starting to set up these mean reversion trades, especially when we're taking that contra trend trade. We're fighting the trend that's being established. I really want to start looking for those mean reversion trades that are going to give me 5 to 1. Now, what I can do though is, a 5 to 1 trade is a lot easier to make into a 2 to 1 or 3 to 1 trade. But, if I'm setting up a mean reversion trade that's only 2 to 1 or 3 to 1, then it's difficult for me to get 5 to 1. Now, in this example here, I have to be respectful of the mean. In other words, as price continues to move higher and time goes on, you will see a convergence of both price and the mean. Now, I have to respect this because this is a re-engagement of a downtrend. So at this point on this mean reversion trade, yes, I would love to have gotten 5 to 1, but at this point, I think we'd have to say we've reached an intermediate target, and we've got about 2.6, 2.7 to 1 on a trade. So we risked about $450 to make about $1,200. Not a bad trade if you think about it in terms of risk reward and the final outcome. So let's summarize what we've just done here. We're using a higher time frame, weekly, to create the condition, that range of probability. We're using the daily to help us find the setup, and then we're using the intraday to do that execution and that risk management. All right, so let's go to a recent trade that I saw. And this is FedEx. And let's go to that weekly. And you can see here that, our bands are starting to turn out, right? That is implying that we're going to see more volatility, probably to the downside. But we did get a huge piercing way outside. So could there be a mean reversion trade here? Yes, there could. Let's go to our daily, the whole candle outside of our Bollinger Bands. Again, we're fighting a downtrend, so I have to be very particular about my setup here in terms of a potential trade. And then I'm going to go down to my 30-minute time frame, and there we see super wide Bollinger Bands. And here is where we have our two candles that are outside. Now, this gold line here represents where price is back inside of our Bollinger Bands. So again, we could use this as a mean reversion trade where we're going to set up this trade as an entry here. We're going to risk this here, this low candle here, and then we're going to look at the daily time frame. So again, I'm going to come over here, get my risk reward. There's my entry. There's my stop. And then on that day, there is my mean reversion. Now this one, again, here's where, as a trader, you have to make that decision. This trade is 3.6 to 1. Again, I really kind of like to find those 5 to 1 trades. Now, maybe we could have maybe lowered our risk a little bit at the 30-minute time frame. Maybe we could have done down to the 15-minute time frame to lower our risk. But again, you have to make that decision as a trader if you're going to take that trade. Again, if we change the parameters since that Bollinger Band piercing, the mean has dropped, and at this point now, lowered our risk to reward. So again, I'd have to be very respectful of this one, especially if we get a quick reversal in price action. All right, I want to show you some other examples here as we go through, but I do see some good questions here, Gene. So let me pause for a moment here and read a couple of these questions and see if we can move forward as well.
Yeah, and as John is reviewing the questions that have come in, I just want to remind everybody that we do have multiple levels of Barchart memberships available for you. There's a free membership that gets you some basic things here and there, some access to different indicators and things that John is showing you. But if you sign up for a Barchart Plus or a Barchart Premier account, it offers up a lot of additional things that you can do, saving charts, saving different study setups. John is doing a lot of drawings on his charts, which he's demonstrating for you today. So if you haven't looked at our membership options, I highly suggest that you do. And we've got the free 30-day trial, so there's absolutely no reason why you should not take a look at enhancing your trading with a Barchart membership. Okay, John, back to you.
Thanks, Gene. Yeah, it's important that, if you're going to start using our website, you're going to be using a lot of our tools. One of the nice features of being a subscribed member is a lot of tools that you design or you're setting these trades up on your charts that will remember them for you. Okay, so I got a question here about the difference between Bollinger Bands and price channels. Again, it depends on how you're setting up your price channels. Personally, I like Bollinger Bands. I feel price channels are a little bit more static, where Bollinger Bands are a little bit more fluid. The question this is from Michael, does it need to close outside of the band to give us a signal, or can it just touch us? Michael, remember what we're talking about is, now that we're learning how to use multiple time frame analysis, is we are looking for that condition first, and then we're going to look for the setups. So again, it varies. Ideally, we would like to see the whole candle outside of the bands, but if we get a wick that pierces outside, or half the candle is outside, that could be significant enough to create that condition. KL asks about breakouts. Does it need to close or just touch during the trading day to work. Again, KL, again, this is a risk management technique depending on the trader. Personally, I wait for the candle, for instance, at the lower time frame, the intraday time frame, to close inside of those dailies and weekly Bollinger Band, outer Bollinger Band. So I like to wait for a close and not necessarily just price piercing above or below. What's the difference? Jeff asks, what's the difference between Bollinger Bands and Keltner channels? Bollinger Bands are based on standard deviation. Keltners are based on something called average true range. So again, average true range is a measurement of volatility. Again, I'm going to show you a page that we have where we kind of blend the two of them together, Keltners and Bollinger Bands. Again, it's just preference. I do use both of them. Says, did is asking, how much screen time do you do once you have identified a signal on a 1 day? So again, what I usually do is if I have a certain set of stocks that I'm trading, in the beginning of the week, so let's say on Sunday night, I will set up my Bollinger Bands at the weekly level. Again, there's that range of probability. And then on each day, I'll look at where the daily Bollinger Bands is. And really kind of looking for is when, that condition occurs when price is going to fall outside of either one or both of those ones. So that's where you do that screen time. Now, and day of trading, it doesn't really take that long to set these trades up. You can put in some alerts on your trading platform, in our trading platform as well. You can set up some alerts when price gets above or below a certain level. Questions, can we use this for the SPY, the SPX? You can use this in any market. Bollinger Bands is basically just a measurement of probability. Robert asks if Bollinger Bands good for options or strictly for stocks. Again, Robert, we can use Bollinger Bands in futures. We can use Bollinger Bands in Forex. I would not use Bollinger Bands in, let's say, a chart of, a particular strike price or something like that. But think about translating Bollinger Bands on an equities chart to a option strategy. In other words, if you're doing a mean reversion, you might be looking at a very short-term call spread or a put spread. If you're looking at a breakout, right, then maybe that's where you're looking for some type of directional or debit option strategy. Okay. Ralph, one of our regulars. Hey, Ralph, how's it going? How do you identify the numbers needed to enter the risk reward calculation? Okay, Ralph, it's again, it's a tool we have here. There it is, risk reward. And then again, if I'm just looking at this in terms of these candles here, what is my entry? Well, my entry is when price gets above, let's say, that price. I'm just clicking on it once. My risk is the low, wherever decided that I'm wrong. And then my target, whatever that target is that I'm going to set up. And then that's how you get the risk reward. So it is based on your technical analysis, your chart analysis, the risk reward picks it up. You just click on each one of those to set that trade up. So if you're having trouble with that, Ralph, send a question to our support staff and they'll help you with this. Which other indicators are combined with Bollinger Bands? So I showed you guys Bollinger Bands with RSI and MACDs. I think those kind of complement each other. All right, I'm going to move on here. I do see some more questions. I'll see if maybe we get some time we can answer some of these. All right. All right, so let's go back to Microsoft. And I'm going to blow this chart out. And I want to go back to, whoops, go back to August 5th here. And again, let's kind of just do this. I think this will help Ralph a little bit here. Again, here's our daily, Ralph. We got the whole candle outside. We're going to go down to our lower time frame to manage our risk. Again, I got to go back in time a little bit here. Let's do this. It's a little easier. There we go. Okay. So this is that August 5th trade. You can look at it on the daily. Again, you know, I'm going to take a trade based on a price returning inside. This is the 30-minute time frame now. We've already discovered the proper condition. So I clicked once there for inside. I've clicked here for my risk, and now I'm going to change my time frame to daily. And again, I got to go back in. Let's go do this, make it so I can get a little bit more data here. So this was that August 5th trade. Let's move this out of the way. So here's where we're setting that trade up, and then we're going to set this up based on, you know, our mean at the time of our trade. Whoop, I want to do this here. So, and I got to fix my stop here is here. And my entry was down here. So again, you can see on this one was a nice 5-to-1 trade that worked out. Okay. So let's go back to Microsoft, and I want to show you a particular trade that happened back in February. And here it is right here. And again, kind of look at this from the perspective of trend analysis, right? We have a defined down sloping moving average telling us that we're in a downtrend. Our Bollinger Bands have gone from narrowing to widening, but you know, price is continuing to stay below our Bollinger Band. That is a good sign. That is for our trend following systems. But we can see here that price comes back and re-engages our moving average. So again, in trend following systems, this is probably an area where we want to re-engage our trend, right? Because in theory of moving averages, price tends to stay above or below a moving average. In this case, a downsloping moving average, price tends to stay below. So again, here we are at the daily level. So we're going to go to our lower time frame. And again, let's look for those blue and purple signals. And here we are. And notice what we're seeing here. So price has been rising. This is 30 minutes now. Remember what we saw in the daily. We were in a well-defined downtrend. Price has been rising contra trend, and price is now reached a level outside of our Bollinger Bands, signaling us that there's a potential for a reversal in price. Our bands have narrowed. Now look at this, which is kind of interesting, is I'm going to just draw a line here at 418, where we see a lot of resistance. Let's go back to the daily for a second. 418 is the intersection. Here it is up here. Here's the brown line is our mean, is the intersection of our moving average, our 20-period moving average. where we want to re-engage our trend. Okay, so what have we learned? Well, we learned that we can take a trend following trade after our bands have narrowed. Look how narrow we are here. And when we want to wait for that confirmation, when price gets to the outer band and breaks structure. Right there. That blue arrow would be our entry signal that allowed us to re-engage our downtrend. And again, I can go in here and use my profit and loss, my risk reward. My entry is going to be here. My risk is going to be my mean. And then my target, well, my target could be, when we get that contra, right? That contra indicator, right? Where that could be a mean reversion, could be an exit to a trend, right? Or I could change my time frame and set that at, again, set that at the outer band at the time of the execution. And in this case, that would have been a 3.7 3-to-1 trade. Okay. All right, let me answer a couple more questions because we're getting closer to the top of the hour, and I do want to finish up. I want to show you a couple web stuff on our web page that you guys can use. So there's a question about short-term versus long-term. So again, if you're a longer-term trader, if you're an investment trader, then you might be setting your range of probability in your monthly time frame and using your weekly as your trend time frame, and then use the daily Bollinger Bands to help you with those executions. So there is a question about, and I've gotten this before in other Bollinger Band ones, is changing the Bollinger Band using 2 or 3 different Bollinger Band defaults. Now, there are some traders that do that. They use, let's say, a 2.2, 2.5, or a 3. Again, that's a preference of individual traders, and maybe what they're looking for is they will wait for the market to go into a 2.2 standard deviation or 2.5 standard deviation, and then they wait for the confirmation to take the trade when price moves back through the 2 standard deviations. But when you think about it in terms of statistics and probability, in terms of how price reacts during 2 standard deviations versus 3 standard deviations, those 2 standard deviations are around 95%. 3 standard deviations, if my math is right, I remember is around 97%. So you're not really picking up a lot more in percentage by doing that. Again, this is just a preference, and I do know that some traders do that. Randy says that he uses, or as asking, is money flow a good indicator that could be used in conjunction with Bollinger Bands? Yeah, again, I don't think there's a right or wrong answer of other tools that you can use. If you like money flow, I think money flow is an excellent tool that you can use. So the question by BK is, are the arrows displayed for Bollinger Band entries and entry points? Yes, those would be points. Now, these are not generated by the website. These were created by me. And yes, that's exactly what they are, KB, excuse me, BK. These would be examples of where we would anticipate, and I'll put this Microsoft trade up here, where we would anticipate potential entries and exits. Okay. Again, if I didn't answer your questions, I apologize. Send them to support@barchart.com and we'll get those answers for you. So Bollinger Band takeaways. Bollinger Bands are an overlaid analysis that can be used in all time frames, but has more significance in higher time frames, dailies and weeklies. And again, the question was, can I use this at a much higher time frame? Yeah, sure. I think you can definitely look at monthlies as well. Check out that FedEx trade. I believe that FedEx trade actually fell into a monthly Bollinger Band. Then again, they work best in concert with other indicators. And again, some of the ones that I like to use are relative strength. But yeah, rely on some of your technical analysis that you've already learned, chart patterns, right? Old resistance, new support, old support, new resistance, breaking out of trading ranges. Keltner bands, right, is a really kind of a way of looking at a ranging market. Narrowing bands represent low volatility and price consolidation, and the expectation is that bands are about to expand, that a trend is about to occur, and wider bands tell us that the market is maybe overextended and that we're stretching like a rubber band, and that when price returns inside the bands, that we're going to snap back to that moving average, that mean reversion. And remember that bands don't predict where prices will go, or when trends are changing, they're just alerting us that the conditions are right for those changes. So let's do this real quick here. Let me show you some tools that we have here. First of all, if you go into stocks, here you have top 100 stocks. And I think this is a really good spot. First of all, you can find great opportunities in here. Remember, these are all stocks that are exhibiting very strong upward trends, but there also would be a great opportunity to think about, stocks that have really moved in a big moment that maybe have gotten a little bit overextended. So in other words, could we find some mean reversion trades, right? Based on Bollinger Bands. Yeah, look at there. Boom. Nice whole candle outside, mean reversion trade. The other thing is, here's the bottom 100. Again, you could look for, those stocks that maybe have been a mean reversion that have gotten overextended to the downside as well. So this is a good way for you to kind of go in here and improve your trading skills. In other words, go and find some examples and then do that multiple time frame analysis to help you manage risk and help you determine that risk reward. And what you'll recognize is that a lot of the trades that you might see, those mean reversion trades, some of them are not good, right? And what makes them a good trade, what makes them a bad trade. The other one, and this goes to the question about Keltner bands, is under the investment page, we have something called the TTM squeeze. Now, the TTM squeeze is a combination of both the Bollinger Band and Keltner bands. If you're interested in this one, you can go to our archived webinars, and I've done a webinar on the TTM squeeze. But again, this combination. So a triggered stock is a stock that is in consolidation or in that coiling. So these could be those potential stocks that are ready to break out of range. So that precursor condition. So you can find some good opportunities there. The long squeeze is again the breakout of the band to the upside. The short squeeze is the breakout to the band to the downside. Again, you could use this page to look for trading ideas, actionable ideas. But again, I think this is a great place to get started to sharpen your skills. Go and look at long squeezes, go and look at short squeezes and see which ones worked out well using the Bollinger Band theory, which ones didn't work out. And there's a way to kind of do that multiple time frame analysis. So I recommend that you use those couple pages, okay? All right, so what we have one more takeaway. And one final thought. Like all technical analysis, timeframes are relative, and that trend is paramount. Remember, when we're doing mean reversion trades with Bollinger Bands, we are fighting the trend. We typically, or ideally, we want to find those lower time frame mean reversions that are actually with our higher primary trend. That would be ideal. But risk management is crucial or critical in all of these setups. And every trader has a different style or tactics, approach, timelines, markets they like to trade, high volatility, low volatility markets. And Bollinger Bands are just one of many tools that traders can use. I personally enjoy using Bollinger Bands. I find them very enhancing into my trade, and I find that when I can find those trades where I can get setups of 5-to-1 or greater, those are the ones that tend to work, even though they might not get me my 5-to-1. But I certainly feel that they're very successful in getting me to that closer to that 3-to-1. And if I'm doing trend following systems and I can get 3-to-1 on a trade, then I only need to be right 40% of the time. Keep that in mind. Okay. So I do see some more questions here. Again, I promise, forgive me for not getting to them, and send those back to support. We'll get them answered for you. All right, so next week, upcoming webinar is, oh yeah, we're going to look at, we're going to move on to volatility and options. We're going to look at rank and percentile and have an idea of how we can use this to help us choose the proper option strategy. So come and check that one if you're interested in that. All right, Gene, I think I'm going to end it at there. Thanks for helping me out again today. Folks, I hope you enjoyed today's session. Give us, if you're watching on our YouTube page, give us a thumbs up. I really would appreciate that. Until next time, be safe out there. Best of health, manage your risk, and the good of all trading.